Welcome. One of the best performing assets of the year has been gold. While it's experienced a little bit of weakness this week, it's still up over 50% for the year at roughly $4,000 an ounce. The rally in gold has been referred to as the debasement trade, based on the idea that governments as debtor nations have an incentive to weaken their currency through excessively accommodative monetary policy that devalues their currency and causes investors to look for an alternative store of value. The accompanying chart here shows gold's performance in the filled in gold color in the S&P 500 in the thin blue line since the market peak of 2007. And what we see is that there are periods of high correlation between the two asset classes and periods of negative correlation. In a somewhat similar period to the spring of 2020, if we go all the way to the left-hand side of the chart here, we see what happened after the 2008 financial crisis when central banks poured huge amounts of stimulus into the financial system, and many investors began to worry about runaway inflation and the collapse of the dollar. And this led to gold prices doubling from 2009 to 2011, reaching about $1,900 an ounce before pulling back to about $1,000 an ounce as inflation fears subsided. What we've seen again since 2020 is a similar story in that people have been concerned about all the new money creation devaluing the existing dollars in circulation and therefore looking for something that can at least keep up with the inflation, if not outpace it. Okay, we just saw gold and stock prices. Now let's look at something where there's a more defined correlation. Here we see gold in relation to interest rates. Now, gold prices often move in the opposite direction of interest rates. In this chart, gold prices is represented by the filled in gold area, and interest rates are the thin lines that, starting from the left, generally slope downward. And what we see is that as interest rates are falling, gold prices tend to rise. And this is partly because central banks, through stimulative monetary policy, can weaken fiat currency. Fiat currency, let's just think of as paper money, through government deficit spending and money printing, causing perceived stores of value, such as gold, to be more in demand. Said differently, when more of something is created, it's necessarily worth less. I think of as a kid collecting baseball cards, and there was this famed Honus Wagner rookie card that was worth a fortune at the time because there was only one of them. But if suddenly in some grandmother's attic, they find 15 more of these Honus Wagner rookie cards, then that one that was previously known to exist is suddenly worth less because there are more of them in circulation. The same applies to money. As central banks print more money, the existing dollars in circulation are worth less. And what does falling interest rates do? It's designed to stimulate economic activity, which means new money is worked into the system, which means the existing dollars in circulation are worth less. So there are a lot of ways to try to preserve and grow the value of your wealth to protect against inflation, and gold is one of those potential options. It should be remembered, of course, when owning gold that it pays no dividend and it has no earnings or no fundamental valuation. So it's difficult to predict exactly where the price may go in the future, but it should be considered as one potential component of a balanced, diversified portfolio. Thanks for watching. Enjoy today.